Hi guys, a good day to all of you. I'm Shemal Mustapha and I'll be your lecturer as far as the subject performance operations goes as part of this particular revision lecture series that has been organized especially for you guys. Now, before I proceed with my lecture, let me tell you what I have planned during the course of this next 90 minutes. As my first segment, I intend to sort of elaborate on something that you guys are already very much familiar with, which is of course your paper structure. And then I want to move on to my next segment, which is to explain to you the syllabus content, again something which I'm pretty sure most of you guys are already familiar with. And from that point onwards, I move on to the most important segment of this particular session, which is to identify certain key areas of your syllabus and explain them to you in detail. And as the last segment of this particular session, I wish to highlight some examination tips and some key aspects that you guys need to consider as far as you are approaching your exam. So moving on, as far as your paper structure goes, it's not something that should be too unfamiliar to you guys, because it's the same paper structure that is adapted throughout all three subjects under your operational level syllabus. Of course, you have a section A which accounts for 20 marks, and these 20 marks are made out of 2-mark questions, 3-mark questions, as well as 4-mark questions. And you need to understand that you can have calculation questions and also theory questions, MCQs, etc., etc. Moving on to section B. Section B will account for 30 marks, and these 30 marks will be made out of 6 questions, each accounting for 5 marks each. Usually you will find that you come across 3 calculations and 3 theory area questions, 3 write-ups basically. Some questions, do not be surprised, you can even find out a mix of calculations as well as a write-up. And then you move on to section C, which is a bulky section as far as your marks goes, which is your section C, which accounts for 50 marks. Now the examiner has said that he could ask you one big question that accounts for 50 marks, or else 2 separate questions which accounts for 25 marks each. The most popular thing, of course, is to have 2 separate questions, a question 3 which could either be from ABC or standard costing, and a question 4 which would be obviously from your most popular investment appraisal. So moving on to the syllabus. As far as your syllabus goes, you have cost accounting systems accounting for 30%, forecasting and budgeting accounting for 10%, investment appraisal that accounts for 25%, dealing with uncertainty which accounts for 15%, and of course working capital management which accounts for 20%. Now before I move on to the next particular segment, I want to reiterate the fact that we Asians are very good at crunching the numbers, but this particular paper of performance operations is not essentially only a number crunching game. You will not be surprised, or do not be surprised, because you can get, it's usually a 30-70 split of write-up and calculations. So it tells you that you shouldn't approach the exam with that mindset of, you're going to only crunch the numbers. You need to remember that there is a significant portion, 30 marks to 35 marks, which would be from write-ups, and you need to make sure that you place or your study is focused towards that particular segment as well. As far as the syllabus content is concerned, so obviously due to time constraints, I will not be able to discuss all 5 of these chapters, but I had the option of discussing more of little or a little of more, and I thought the best approach would be to have a more comprehensive discussion on selected chapters. So the chapters that I will be taking up as part of my discussion is number 1, cost accounting systems, which accounts for 30% of your syllabus. Number 2, investment appraisal, which accounts for 25% of your syllabus. And then working capital management, which accounts for a 20% of your syllabus. Moving on. As far as cost accounting system goes, I can split this particular chapter into 4 main areas. One thing is dealing with overheads. The next thing, standard costing, throughput accounting, and finally, modern business environment. As far as overheads are concerned, the sub areas, you have a marginal versus absorption costing area. Then you have an activity-based costing area. The marginal versus absorption costing area is more often than not tested as part of your section A or B, and activity-based costing is usually tested as a section C 25-mark question. As far as standard costing goes, the sub areas, I could split that into basic variances, advanced variances, and discussion elements. And standard costing is, as you may know already, as you may have realized already, is a very popular area that is tested as part of your section C as a 25 marker. Moving on, you have throughput accounting, section A and section B usually tested, and modern business environments, which is usually tested as a section B write-up. You might find 1 or 2 questions coming from modern business environment. Moving on, as far as overheads are concerned, marginal versus absorption, what do they actually mean? When I refer to marginal costing, essentially the technical definition of a marginal cost is the incremental cost to produce one more additional unit. So essentially, marginal cost boils down to all variable costs. And then you have something called full production cost, which is used to value your stock under absorption costing. And as far as full production cost is concerned, the full production cost is equal to, it boils down to all of your variable cost, and to that you also add a certain portion of your you absorb a certain portion of your fixed overheads. So a very important aspect that you guys need to understand is when you prepare the profit statements for marginal costing and absorption costing, remember the stock is always valued at production cost, whether it is marginal production cost or full production cost, of course depends on the question, but make sure that your stock is always valued at the production cost. And another very important area that you need to, which I wish to highlight, is the reconciliation of profit and profit. Another, popular area that is tested as far as your exam is concerned, which is how you convert your marginal costing profit to your absorption costing profit. So a very famous equation is, which is shown in your slide, I believe. Absorption costing profit is equal to the marginal costing profit plus delta stock. That's the closing stock minus the opening stock multiplied by the overhead absorption rate per unit. What I refer to as overhead absorption rate per unit is the amount of fixed overheads that you will be absorbing to 1 unit of product. Moving on, how do we prepare the marginal costing profit statement and an absorption costing profit statement? The very important thing that you need to identify here is that as far as an absorption costing profit statement goes, there are 2 main segments. One is your production cost and then your non-production cost. If you look at the marginal costing profit statement, that again is split into 2 main segments. One which is your variable cost and then your fixed cost. So as far as your absorption costing profit is concerned, it's very, very similar to the profit statements that you would be preparing under your financial accounting. You have your sales and then cost of sales. Under cost of sales, I have included, make sure that you always consider the full production cost of the sales units. So some people, they start with opening stock, add the production units, deduct the closing stock, but you can combine all of them together and straight away deduct the full production cost. And to that then you need to subtract or add the under or over absorption, which is equal to the overhead absorption rate multiplied by the actual activity level, again actual production units over here, because the cost depends on the number of units that you produce minus your actual fixed cost. So if it is an under absorption, you make sure you deduct it. If it's an over absorption, you add that. You end up with your gross profit, and from your gross profit then you need to deduct all your non-production costs, and then you end up with net profit. Guys, let us take a break, and when we come back we will be discussing how to prepare a marginal costing profit statement. Welcome back. So we were discussing on how to prepare profit statements under absorption costing and marginal costing. Before the break, we identified how we are going to prepare a profit statement under absorption costing. So now let us identify how to prepare a profit statement under marginal costing. As I mentioned earlier, marginal costing profit statement comprises of two segments. One, which is your variable cost, and then your fixed cost. So you start with sales again, but now make sure you deduct all the variable production costs of sales units. So in the absorption costing statement, we deducted the full production cost of sales units, but here we're deducting only the variable production cost, and after that you deduct the variable non-production cost. So sales minus variable costs, you know, is your contribution, and from your contribution then you deduct all of your fixed costs. So when I say all the fixed costs, I'm referring to both production fixed costs as well as the non-production fixed costs, and finally you end up with net profit. Now from an examination perspective, more often than not the examiner tends to ignore these non-production costs. So you will essentially be asked to reconcile the gross profits of absorption costing profit and marginal costing profit. So if that is okay, we can then move on to the next section, a very important section again, which is activity-based costing. Now, activity-based costing is an alternative that was put forward to absorption costing. In absorption costing, what you essentially do is you tend to calculate one blanket rate to absorb overheads. And the method of absorption may not necessarily be accurate. The method of absorption, the way in which you calculate your overhead absorption rate is usually based on the factor which governs most of your overheads, but not all of your overheads. So essentially what happens is a small portion of your overheads are not actually absorbed based on real reasoning. So this sort of led people to believe that absorption costing is not the most accurate method of absorbing overheads. So therefore an alternative was put forward by the name activity-based costing. So in activity-based costing, what essentially happens is you try to build these fictitious locations and accumulate all the overheads to these fictitious locations. You accumulate all the overheads that depend on the same cost driver. So what essentially happens is then you calculate a cost per driver for each of these cost pools, and then those cost per drivers are absorbed to the product based on the number of drivers that will be consumed by each product. So as far as a typical examination question is concerned from activity-based costing, the steps that you need to follow is first you need to identify your cost pools and your cost drivers. So this part you will usually find is already given in the question. The question will give you what the cost pools are, and for each cost pool you will find what the cost drivers are as well. And then you need to identify the cost belonging to each cost pool. This again more often than not will be included in the question. So far the first two steps are the stuff that have already been included in the question. And after that you need to identify the volume of drivers for each pool. Now the number of drivers belonging to each pool, this might involve a small calculation that you would have to calculate based on information given in the question. So upon finding the volume of drivers for each pool, you calculate a cost per driver. And then this cost per driver is used to ascertain your overhead cost to the product. So it's very simple as long as you follow the right approach. It's an area which most of the students tend to go wrong, mainly because they approach it unprepared. So as long as you're prepared well, it's a very easy area where you can score a lot of marks from. The next thing that I want to highlight is when are we going to use activity-based costing. Now, we don't use activity-based costing all the time. We use activity-based costing only when the overhead costs form a large portion of your total cost. We call that the materiality concept. So unless you are having a significant portion of overheads as part of your total cost, going with activity-based costing may not be the most suitable method, mainly because it is not worth it. And then the next main reason when you're going to use activity-based costing is you need to make sure that the overheads are non-volume driven, meaning the overheads are not directly dependent on the number of units. If that is so, then again you will find that absorption costing and activity-based costing will give similar results. So you need to make sure that the overheads are non-volume driven. Another popularly tested, heavily tested area. So what are the advantages of ABC? So what are the advantages of ABC? One thing is, of course, accuracy. Why accuracy? Because you're absorbing overheads based on the real reasons. The next thing is, because of this accuracy, it leads to improved decision making. Because you're identifying a more accurate cost, because you're absorbing a more accurate cost, eventually the price that you come out with for that particular product will also be a more accurate one. So therefore it leads to improved decision making. And then of course, because you're identifying the real reasons, whenever something goes wrong, you know what could have led to that increase in cost, because now you have identified the correct reasons. So therefore, on an overall perspective, it also leads to better cost management and control. Let us then move on to standard costing. Let me brush up the basic variances. You have two sales variances. One is your sales price variance, which is the difference between the standard selling price, your actual selling price, and make sure that you multiply it by the actual units sold. So if it is a JIT environment, you will find that the sales units and production units are the same. But if it is not, then make sure that you multiply all your sales variances by the actual units sold and not the actual units produced. As far as your sales volume variance is concerned, you need to make sure, read the question carefully and try to identify what method of costing is being used by the organization. If it is marginal costing, then the difference between budgeted units and actual units will be multiplied by the standard contribution per unit. But if the organization is using absorption costing, then your sales volume variance will be calculated by multiplying the difference between budgeted units and actual units by the standard profit per unit. Now there are different equations that you can use, but based on these equations that I have indicated in this particular slide, a negative answer will lead to a favorable variance and a positive answer will lead to an adverse variance. Moving on to all of the variable cost variances. So when I say variable cost variances, I am referring to the material variances, labor variances, as well as the variable overhead variances. So you have two main types. One thing I can categorize as price, rate or expense, that is material price, labor rate or variable overhead expenditure variance. How do you calculate it? It's the difference between standard rate and actual rate, and that is multiplied by actual purchases. And then the usage, the materials usage, labor efficiency or variable overhead efficiency variance. How do we calculate that? It's essentially the difference between your standard usage and actual usage multiplied by the standard rate. Now when I say standard usage, remember standard usage is equal to the standard consumption per unit multiplied by the actual number of units produced. Another important thing that I want to highlight here is something called revised standard usage. We will be coming across this at a later area when I'm discussing planning and operating variances. As far as revised standard usage is concerned, again, you're going to revise only the standard usage per unit. You will not be revising the number of units. The number of units will still continue to be actual units. So the revised standard usage will be equal to revised standard usage per unit multiplied by the actual number of units. Guys, let us take a break, and once we come back, I will proceed to the remaining variable cost variances. Welcome back. So So continuing with our cost variances, we can then proceed to discuss our fixed overhead variances. There are two categories. One thing is the expenditure variance. So the expenditure variance, you calculate it as a difference between the budgeted fixed cost and your actual fixed cost. And as far as your fixed overhead volume variance is concerned, it's a difference between actual units and budgeted units multiplied by your overhead absorption rate per unit. One very important thing that I want to highlight here is that you cannot calculate a fixed overhead volume variance when you are using marginal costing. You can calculate a fixed overhead volume variance only under absorption costing. It's a very important point which students tend to forget at the exam, but make sure that you don't make the mistake of calculating a volume variance when you are using marginal costing. And then the last variance is an idle time variance. The idle time variance is equal to the idle time multiplied by the standard rate, and as far as an idle time variance goes, it is an adverse variance all the time. Moving on to another very important section, which is about mix and yield variances. Before I move into an elaborative discussion or a calculation of mix and yield variance, let me first explain to you the exact meaning of a mix and yield variance. Let's say you are in an industry that is manufacturing chemicals. So to produce a certain chemical, you may need several materials, and these materials you may have to mix it in certain standard proportions. So for example, let's assume that you're going to be using materials A, B and C to come up with a certain chemical, and you're supposed to mix them in a ratio of 1:2:3. But due to something that happens in your production plant, the actual mix differs from the standard mix. Maybe you end up mixing ABC in a ratio of 2:3:5, which may not essentially be the standard mix. So this difference between the standard mix and actual mix will give rise to what we call a mix variance. Then what is yield variance? What I refer to as a yield variance is, now you have changed the standard mix. So when you change the standard mix, the actual output that you get is also obviously going to differ from the output that you expect. So this difference or this variance between the actual output and the standard output is what we call a yield variance. So calculation of mix and yield variance can be best explained by the use of a simple example. Let's consider three materials A, B and C, which are supposed to be mixed in the ratio of 1:2:3 liters in order to provide an output of 5 liters. So when you mix materials A, B and C in a ratio of 1:2:3, you can expect an output of 5 liters. So note, you're mixing 6 liters, 1 plus 2 plus 3, but you're getting an output of only 5 liters. So that 1 liter is actually normal loss. So do not worry too much about that, but don't worry that why the input is not equal to output. Well, there can always be a normal loss. But in reality, you have ended up mixing your materials in a ratio of 2:3:1. That is 2000 liters, 3000 liters and 1000 liters, and you have got an actual output of 4500. So in reality, you have mixed a total of 6000 liters, but not in your standard mix proportion. Because you didn't mix it in your standard mix proportion, the actual output that you have got has also been different. Because if you had used your standard mix, 6000 liters of input should have given 5000 liters of output, which has not actually materialized. So the best way to work out this example is to construct what I call a mix and yield variance table. So if you pay attention to the slide, you can construct a table as the three input materials A, B and C. You have a total input column and then you have a total output column. So the first thing that you're going to do is you're going to input the data that you get from the question. which is your standard mix. So your standard mix is 1:2:3 of materials A, B and C, which means your total input is going to be 6 liters. And a 6 liters of input when mixed in standard proportions is going to give you an output of 5 liters. And then again you feed data from the question, which is your actual mix. You have actually mixed 2000 liters of A, 3000 liters of B and 1000 liters of C. Again the total input is 6000, but because you have not mixed it in standard proportions, you are getting an output of only 4500. So now the next important step is one thing that you need to carefully analyze. You try to ask yourself, look here, let me use the same actual input, but what happens if I had used this actual input in my standard proportions? So again, you're using the 6000 liters, but you're going to now use them in your standard mix proportion of 1:2:3. So if you utilize 6000 liters in your standard proportion, you will effectively be using 1000 liters of A, 2000 liters of B and 3000 liters of C. Again, if you used standard mix, you should have essentially got 5000 liters of output, because we identified according to the question, when 6 liters of output is used in standard mix proportion, it gives 5 liters as output. So if you're going to use 6000 liters, you will essentially get 5000 liters as your output. So now the next step, again, lot of students make this mistake. They try to interpret whether it's adverse or favorable based on the sign. But just pay attention to what I am going to teach you guys here. Now, if I compare the rows 2 and 3, I'm supposed to use only 1000 liters of A, but I have ended up using more. I have ended up using 2000 liters of A. So I'm looking at the input side. I was supposed to use 1000, but I have ended up using 2000. So I have ended up using 1000 liters more, which gives rise to an adverse variance of 1000 in liters. Similarly, if you look at B, I was supposed to use 2000 liters, but I ended up using 3000 liters. So again, I have used 1000 liters more than what I anticipated. Therefore, that gives rise to an adverse variance of 1000. But if I take a look at C, I was supposed to use 3000, whereas I have actually ended up using less. So this is actually good for the company. So therefore, that gives rise to a variance of 2000, but of course a favorable variance. But moving on to the output side. Now the interpretation of the output side should be slightly different. You were supposed to get 5000 liters, but you have actually got less of output. So you were supposed to get 5000 liters, but you have actually ended up getting only 4500. So you've actually got 500 liters less, which is not good, and therefore it is an adverse variance of 500. So be very careful when you mark whether it's adverse or favorable. Your interpretation should always be based on common understanding, logic, not whether it is positive or negative. So after constructing the variances in liters, in order to ascertain a value to that, I need to multiply it by the respective prices. So let me assume that the prices are 10, 5 and 2 for materials A, B and C. So I multiply 1000 by 10, I end up with 10,000. I multiply 1000 by 5, I end up with a 5000 adverse. I multiply 2000 by 2, I end up with a 4000 favorable. Now with regards to the respective price per liter of output, remember, it is, most of the students make this mistake. They think that that is just a weighted average price. In reality, it is not. The real thing that is happening there is that you have to multiply it by the price per unit of output. So you're using 6 liters. So the 6 liters of input is going to cost you 10 times 1 of A plus 5 times 2 of B plus 2 times 3, which is going to be equal to 26. So 6 liters of input in the standard mix is going to be 26, but that you need to divide it by 5, not 6, because you're getting only 5 liters of output from the 6 liters of input. So therefore the standard price per liter of output is actually 5.2. It is not just a simple weighted average calculation. It is in fact the price per unit of output. So that 500, then you multiply it by a 5.2, you end up with a 2600 adverse. So what you get from your input side, as I discussed earlier, is what we call a mix variance. So the total mix variance will end up with a net effect of 11,000 adverse, and what you get from the output side is essentially your yield variance, and that will boil down to a 2600 adverse. Guys, let us take a small break, and when we come back after the break, let me proceed to discuss sales mix and quantity variances. Guys, welcome back. Let us proceed to then move on with our discussion as far as sales and mix variance goes. So sales mix variance, you will realize, is very similar to material mix variance. The calculation is also very straightforward. You fill in the column of standard mix, your actual mix, then you adjust your actual mix to your standard mix, identify the variance, and you multiply either by the contribution per unit or by the profit per unit. You will be multiplying it by the contribution per unit under marginal costing, and you will be multiplying it by the profit per unit under absorption costing, and then you will end up with the variance. This is the total of this will be equal to your sales mix variance. So it's very similar to your material mix variance, but remember, the sales quantity variance may be the equivalent of yield variance but not exactly the same. So first let me discuss the calculation part of it. Under marginal costing, how do we calculate sales quantity variance? It is the difference of budgeted total sales and actual total sales multiplied by the weighted average contribution per unit. And under absorption costing, it is the difference between the budgeted total sales and actual total sales multiplied by the weighted average profit per unit. So what is the relationship between sales mix, sales quantity, and sales volume variance? Again, this is best explained in the form of an example. Let's assume an organization sells two products A and B. So you're going to estimate, you have estimated 1000 units of A, 2000 units of B, which means your budgeted sales is only 3000. And your sales mix, your standard mix, is 1:2. Moving on to reality, you're selling a total of 4500 units, but not in the standard proportion of 1:2, but in a different mix. So therefore you're ending up selling 2000 units of A and 2500 units of B. So what you need to realize here is that you estimated 3000 units of quantity to be sold, but you have ended up selling 1500 units more in terms of the quantity. So what we calculate as sales quantity variance is the difference between the budgeted total sales quantity and the actual sales quantity. So as a result of the total quantity changing from what you estimated, it gives rise to a sales quantity variance. However, you will realize that the mix has also changed. If you were to sell 4500 in the standard mix, you should have ideally sold 1500 units of A and 3000 units of B, which has actually not happened. So as a result of that, it gives rise to what we call a sales mix variance. And it can be proven mathematically that your sales mix variance plus your sales quantity variance will eventually end up being equal to your sales volume variance. Fine. Let us then move on to our discussion on planning and operating variances. What we refer to as a planning variance is the difference between the original standard and revised standard. What we refer to as operating variance is the variance between your revised standard and actual performance. So there are various instances where an organization believes, look here, it's not practically correct to compare performance or evaluate performance based on an original standard. So therefore they introduce what is called a revised standard, and this is what gives rise to planning variances and operating variances. So calculation, if you pay attention to the slide, I am adjusting my standard variance formulae to reflect on my revised standards. So let me first consider for planning variances. Usually a price variance is measured as the difference between standard price and actual price multiplied by the actual usage. But in the case of a planning variance, you're not going to be comparing the standard and the actual. What you're essentially trying to do is you're trying to compare the standard and the revised standard. So therefore, wherever there is an actual, I cut that off and make it revised standard. So instead of actual price, what I have is a revised standard price. Instead of actual usage, what I have is a revised standard usage. Now you need to remember, when I say revised standard usage is always equal to the revised standard usage per unit multiplied by the actual activity level, not the budgeted activity level. So although you're revising the standard, you're revising only the standard usage per unit. The actual units, well, that is still used to calculate the revised standard usage. Similarly, in the case of a usage variance, you're not going to be comparing standard usage and actual usage. You're going to compare the standard usage and the revised standard usage. So where you have actual usage, you can replace that with revised standard usage, and that will give you your planning usage variance. As far as the operating variance are concerned, again it's very much similar. Normally you compare standard and actual. But in the case of an operating variance, what you essentially need is not your original standard and actual. What you need now is your revised standard and your actual. So wherever you have standard, you slash that, make that revised standard. So when you have standard price, you cut that off, you make it revised standard price. When you have standard usage, you cut that off, you make that revised standard usage. But again, remember, when I say revised standard usage is equal to the revised standard usage per unit multiplied by the actual activity level, that is the actual units of production. So what are the popular theory areas that are usually tested in standard costing? One thing is with regards to the factors to be considered before investigating a variance. So you need to know that it's not always, you're not going to investigate into all the variances. It's not worth it. So therefore you need to find out which variances you are essentially going to go ahead and investigate. So the factors that you will be considering before you make that conscious decision is, one thing, the size of the variance. So these small variances sometimes might not be worthwhile. So the size of the variance is something that you're definitely going to consider. The next thing being the controllability. To what extent did you have control over that variance? Because sometimes maybe the whole market, the material prices went up. So therefore obviously it led to an adverse variance. So you did not have control over that. So investigating and investing time into that investigation may not necessarily be worth it. The next thing is the cost of the investigation. So if the variance is 1,000 and the cost of investigating is going to be 10,000, then of course it's pointless to investigate that variance. So the cost of the investigation will also matter. And last but not least, you will also have to focus on the interrelationships between variances, because sometimes investigating one variance might explain the reason for the other variance. For example, you bought low quality material which happened to be cheap. So therefore you ended up with a favorable material variance because the material was cheap. But cheap things are no good. So therefore the quality of those materials would have been very low. So when the quality of the materials are low, as far as wastage is concerned, it would have been high, and then the usage variance would have become adverse. So if you investigated just the material price variance, it would have essentially explained the reason for the material usage variance as well. So therefore it's very important that you also understand the interrelationship between variances. The next thing is, what are the benefits of segregating planning and operating variances? So what are these benefits? One benefit is, of course, there is a better assessment of controllability and responsibility. Whenever you're segregating variances, say you have identified the planning variance to be 1,000 adverse and an operating variance to be 2,000 favorable. So now you know who is at or who was at fault or who needs to be blamed. So the better assessment of controllability and responsibility is one important feature that you get out of planning and operating variances. The next thing is that now you're quantifying your planning. So if you don't have planning and operating variances, the planning guys come up with some kind of absurd standard, nobody complains. It's always the poor performance guy who will be seen to be at fault. But now, because you're measuring a planning variance, there is more emphasis on planning. And also another thing is very useful under changing market conditions, because let's say the markets are always changing. It's very important that you continuously revise your standards. So therefore, in a case where you have to introduce a revised standard as a result of dynamic market conditions, even then you will find that it is useful to have planning and operating variances separately. The next thing is, why is standard costing not useful in a modern manufacturing environment? Why is it not useful? One thing, in a modern manufacturing environment, there is a lot of customization. So the essence of standard costing is when you can standardize your products. If you cannot standardize your products, you cannot have standard costing. So when you have more customization, standard costing may not be the most suitable approach. Then the next thing, under modern market conditions, it's very difficult to set stable standards. Why? Because the market is always changing. So you might have to revise your standards all the time, may not be worthwhile. The next thing is, production is highly automated. It's not labor intensive. If your production is labor intensive, you know that a standard, when you set a standard, you could influence the labor behavior. But when it is automated, whatever change that you make to your standard, the machines are going to produce the way they want. So in a scenario like that, standard costing may not be the most suitable. And then nowadays there's an emphasis on continuous improvement, meaning the standard, you're always given a challenging standard. So in a real scenario, what is essentially happening is you're setting what is called ideal standards, where you're not leaving any room for there to be, that's some kind of tolerance. So that leads to demotivation. And then in the case of standard costing, your variance reports sometimes arrive too late and they do not essentially solve your problems. So what you just get is reports, maybe they don't essentially solve your problems. And another very important or popularly tested theory area is, how would sales volume variance differ under marginal costing and absorption costing? So main difference is sales volume variance under marginal costing. You will realize you're multiplying it by the contribution per unit. But under absorption costing, you will be multiplying it by the profit per unit. So therefore, the sales volume variance will differ. You will get two different answers based on whether you're using marginal costing or absorption costing. And another very important point to note is that this change between the sales volume variance is actually accommodated by your fixed overhead volume variance, which you calculate only in absorption costing. You don't get a fixed overhead volume variance in marginal costing. So you will find out mathematically, it can be proven that the sales volume variance calculated under absorption costing, and to that if you add the fixed overhead volume variance, which you calculate only under absorption costing, that would be equal to the sales volume variance that you calculate under marginal costing. Guys, moving on to our discussion on investment appraisal, which is another heavily tested area as far as your exam is concerned. Accounts for 25% of your syllabus. So in this particular area, I wish to focus my discussion on net present value, IRR, payback period, accounting rate of return, discuss a little bit on post-completion audits and project abandonment. And also, as far as the further aspects of investment appraisal is concerned, I want to discuss a bit on sensitivity analysis, relevant cash flows, non-relevant cash flows, how are we going to deal with taxation and inflation, how are we going to deal with working capital, what about capital asset replacement decisions, and also about capital rationing. Guys, this I will do in the next episode. I hope you guys benefited a lot out of this. I'll see you guys next time around. Thank you very much.